Something is broken in the global financial system, and the price of gold is the smoke alarm. If you look at the chart today, it looks like a glitch in the matrix. By every textbook definition of finance, gold should be crashing right now. Interest rates are sitting at 5%. The US dollar is relatively strong against global peers. The stock market is trading near all-time highs. In a normal world, gold, which pays you zero interest and costs money to store, should be dead money. Instead, it is trading like a high-growth tech stock. It is ripped over 60% higher in a straight line. Silver is drafting right behind it. We're seeing lines outside bullion dealers from Shanghai to Costco. Yes, Costco, where people are throwing 1-ounce gold bars into their carts next to the rotisserie chickens. The search volume for how to buy gold has gone vertical. The headline everyone is selling you to explain this is simple: the dollar is dying. The narrative goes like this. The US government is drowning in $35 trillion of debt. The Federal Reserve has lost control. Hyperinflation is around the corner. Therefore, the only way to survive is to own a heavy yellow metal that fits in a safe. It is a terrifying story. It is compelling. And frankly, it sells a lot of newsletters. But if you're putting your life savings into this trade based on that headline, you are playing a dangerous. You are reacting to the symptom, not the disease. We need to strip away the fear-mongering and look at the actual plumbing. We need to answer the trillion-dollar question. Why is gold exploding now, when the US economy is supposedly strong? To understand this, you have to understand the broken rule. For 40 years, Wall Street had a simple algorithm for gold. It was an inverse correlation with real interest rates. Here is the logic. Gold pays you nothing. It yields 0%. It produces no cash flow. In fact, it has a negative yield because you have to pay to store it and insure it. It is a lazy asset. So, when interest rates are high, like they are right now, with cash paying you roughly 5%, gold should crash. Why hold a rock that costs money to store when you can hold risk-free US Treasury bills paying you a guaranteed 5% yield? That is the opportunity cost of gold. When money is expensive, gold usually dies. That relationship held true for decades. Until 2022. In 2022, the Federal Reserve hiked rates faster than at any point in history. By all conventional logic, gold should have collapsed to $1,600 or lower. It didn't. It held the line. And then, it started to moon. This is the anomaly. The broken rule is the most important signal in global finance right now. It tells us that the buyers driving this rally do not care about years. They don't care about making 5% on a T-bill. So who are they? And what are they actually afraid of? The answer lies in the weaponization of the dollar. Go back to February 2022. Russia invades Ukraine. The US and Europe respond by freezing roughly $300 billion of Russian central bank assets. Effectively, the West told the world, if you cross us, your dollar reserves are no longer your money. They are ours. Whether you agree with that politically is irrelevant. Financially, it sent a shockwave through the global South. It broke the trust that underpins the reserve currency system. If you are China, if you are Saudi Arabia, if you are Brazil, you watched that happen and you did the math. You realize that holding US treasuries is no longer a risk-free trade. It carries a massive political risk. If you get into a diplomatic spat with Washington, your national savings account could disappear overnight. This triggered a massive rotation in the plumbing of global reserves. Central banks aren't buying gold because they think the dollar will be worthless next Tuesday. They are buying gold because it is the only neutral reserve asset. It has no counterparty. It is not someone else's liability. If you have the gold in your vault, nobody can sanction it, nobody can freeze it. Look at the data. The biggest buyers are not the Federal Reserve or the ECB. The whales are the People's Bank of China, Turkey, India, Poland, and Singapore. This is a geopolitical divorce. These countries are building a settlement layer that doesn't rely on the SWIFT banking system. That is the first engine, geopolitics. The second engine is fiscal dominance. This is the scary part of the debt story, but not for the reason you think. The US government is currently spending more on interest payments for its debt than it spends on the entire defense budget. When interest payments get that high, the math gets ugly. The market begins to realize that there is no way to pay this back in real terms. The government has two choices. First, they can default on the debt. This destroys the global banking system, so it is off the table. Second, they can choose financial repression. Financial repression is when you keep interest rates lower than inflation for a decade to inflate the debt away. You pay back your bondholders with money that is worth less than when they lent it to you. The bond market is sniffing this out. Investors are looking at the U.S. fiscal situation, trillion-dollar deficits as far as the eye can see, regardless of who is in the White House, and they are front-running the inevitable. They are betting that the Federal Reserve will eventually be forced to print money to buy the government's debt, uncapping inflation again. This is called yield curve control, and it's exactly what happened in the 1940s to pay for World War II. This is what we call the debasement trade. It's not that the dollar goes to zero. It's that the purchasing power of the dollar is being slowly, mathematically eroded to keep the government solvent. Gold is simply the scorecard for that erosion. Now, we have to address the biggest trap for retail investors, the miner paradox. If gold is at all-time highs, why aren't gold mining stocks at all-time highs? Why is the GDX, the miners ETF, still below its 2011 peak? This confuses a lot of people. They buy a mining stock thinking it's a leveraged play on gold, and then they lose money while gold goes ebb. The reason is inflation. Gold is a hedge against inflation, but gold miners are victims of inflation. To get gold out of the ground, you need diesel, you need steel, you need labor, and you need explosives. The cost of how those things has skyrocketed. A gold mine is essentially a short position on energy. When oil prices are high and labor markets are tight, the cost to pull an ounce of gold out of the ground jumps significantly. So even though the price of gold is up, the profit margins for the miners have been squeezed. They are running just to stand still. Do not blind buy miners thinking they are the same as the metal. They are businesses with operational risks. If a mine is in a country that decides to nationalize its resources, your stock goes to zero, even if gold goes to $10,000. So, where do we go from here? Is it too late? We have to talk about the price. Just because the thesis is correct doesn't mean the price isn't a bubble in the short term. Markets are manic. They overshoot. Right now, we are seeing signs of retail froth. When your Uber driver is talking about a silver squeeze and mainstream news is running segments on how to protect your 401k with gold, you are in the danger zone. We are seeing massive inflows into leveraged gold ETFs. This suggests that the smart money, the central banks started the move, but the dumb money, retail chasers, is pouring in now at the top. Let's look at the risks. What could kill this rally? Number 1, peace. If geopolitical tensions cool, if there is a ceasefire in Ukraine or a de-escalation in the Middle East, the fear premium embedded in gold evaporates. The desire for a neutral reserve asset becomes less urgent. The price could drop 20% in a month. Number 2, a liquidity crisis. History shows us that when a real recession hits, gold initially crashes. Why? Because when hedge funds blow up and margin calls go out, investors sell whatever they can, not what they want to. They sell their winners to pay for their losers. In 2008, gold dropped 30% initially. In March 2020, gold tanked along with the S&P 500. Gold is liquid, which means it gets sold when people need cash. Number 3, the dollar fights back. If the U.S. economy remains exceptional and Europe or China implodes, the dollar can strengthen purely on a relative basis. If the dollar rips higher, it acts as a massive headwind for commodities. So how do you handle this environment? First, strip out the emotion. Do not buy gold because you are angry at the government or afraid of the apocalypse. If the apocalypse happens, you'll want canned food, water filtration, and ammunition, not shiny rocks. You can't eat gold. Second, understand your time frame. If you are buying physical gold, you are buying insurance. Insurance costs money. The spread, the difference between what you buy and sell for, is high. You are looking at a 10-year hold. If you are buying paper gold hoping for a quick 20% gain, you are gambling on momentum. That works until it doesn't. Third, look at the plumbing, not the price. Watch real yields. Watch the central bank purchase data. If China stops buying, the floor falls out of this market. Here is the bottom line. The gold rally is real, and the reasons behind it are structural. The world is fragmenting, and debt is spiraling. The trust in the U.S. Treasury bond as the pristine collateral of the world has been dented. But trees don't grow to the sky. Parabolic moves almost always correct. The market is designed to transfer wealth from the impatient to the patient. The goal isn't to predict exactly where the price goes next week. The goal is to understand that gold has shifted from a dead asset to a geopolitical necessity for half the world. That trend is your friend, but FOMO is your enemy.